test it out very manually. If you see that take up happening, try and automate it, and then see how it takes off. But then this part is the most important part. Kill it very early.
Yeah.
If you realize this is not working.
Welcome to Sobremesa Podcast, a show featuring interviews with up-and-coming tech founders. You'll hear their stories, key learnings, and the challenges they face as they scale their startups. You'll also get a glimpse into the latest trends and news from true insiders in their industries. Your host, Matthias at FJ Labs, will run the show in the authentic Sobremesa style. That special time spent after a good meal, hanging with friends, and having interesting conversations. So grab your coffee and enjoy the show.
Welcome everybody to another episode of Sobremesa Podcast. With us today, we have Omar, co-founder and CEO of Abhi. Abhi is a fintech startup that provides EWA, earned wage access, to employees around emerging markets, starting in Pakistan, Bangladesh, UAE, and soon many other countries. So the idea behind the EWA model is for employees to get instant access or on-demand access to their earned wages. Meaning if I get paid towards the end of the month, I can have it now when I really need it. But that's just one side of the story, because Abhi also offers invoice financing, payroll financing as well, payroll financing to the employer. So they're servicing employees and employers. I also wanted to bring Omar to a pod because he's one of those entrepreneurs who really know what they're talking about when it comes to emerging market fintech. So buckle up. I expect a wide-ranging conversation. Omar, really happy to have you here. Welcome to Sobremesa.
Matthias, thank you so much for having me on.
Omar, so I want to start from the beginning. Because you are originally from Pakistan. You've lived in the financial capitals of the world. You lived in New York, in London, in Hong Kong. Walk us through this transition between, because you've had experience on the investor side, on the buy side, on the sell side, in Morgan Stanley, Renaissance Capital. Like, why start a company? It's starting a company is hard, man. Like, why, especially in emerging markets? Like, why go through that transition?
I think I'm still asking myself that question today, and my wife is probably questioning it even more. But look, to be honest, it was a couple of things. It's one, the challenge, and I think I touched on this in a couple of things which I spoke about before on another pod. Is I've always been that person that wants to live in the shoes of someone else who's taking a little bit of harder step in a sense, to actually understand what it means. So I'll give you an example. I started off on the buy side, and then when the financial crisis hit, it was the capability of going to another buy side job was there. But really what I wanted to understand was everyone talked a big game about the sell side and how hard it was and how the building blocks are really there. So I stepped into the sell side to see whether I could actually do it and take the challenge on, face on, and put myself in those boots. And so I'd say that was one aspect of it, of me having done buy side, sell side, back to buy side, but different realms of finance. The next leg for me that I saw is very interesting in terms of companies I was investing in, both on the PE side as well as public, and then obviously sitting on the board of the VC side, was the entrepreneurs actually building these companies. And it all sounds great on a PowerPoint presentation when everyone comes in and pitches to you. And I always knew inherently, and this is, I think, the sense of humility you need to have when you're an investor. You need to always know that the person on the other side of the table is typically much smarter than you when it comes to their realm, their business. We can read as many books as we want, and we'll connect the dots as much as we want. But then the person who really knows the business is the one who operates it. So that was one part of it, is that, you know what, I really want the challenge of being able to understand what it is to run a business. And so that was one aspect. The second aspect of it, which was the overarching aspect, was the idea that, look, financial inclusion was something I've seen done in emerging markets. It's been done in very large markets, which are more developed, smaller markets, which are less developed, but I hadn't seen it being done properly, at least, by something that was formidable, that got me excited in Pakistan to begin with. And as you mentioned, I'm originally from Pakistan. If it wasn't for my background of having been lucky enough to live abroad and have those experiences, I'd be in the same boat as everyone else who was still living in Pakistan, right? I lived majority of my life outside Pakistan. So the idea was, if I have this experience, who better to go back and try and make something happen? And if I don't do it, someone else will. So I kind of said, let's go and attack this problem, and try and build that story or a company that's able to attack a large enough issue, and surround myself with other people who I've kind of experienced the rest of my career with, to be able to go and do it with the best earnest capability I can.
Did anything surprise you in terms of the skill set needed to be either on the buy side or sell side, on the kind of financial side, if you want, and being an entrepreneur, maybe on both sides, maybe things that you thought you were lacking when you started Abhi, and on the flip side, things that you said like, hey, this is, actually very useful that I did this in the past?
Yeah, lots is the truth. You know nothing coming into this, is the basic premise, and you have to enter it that way. I think there's an air of hubris that people may have coming from investment banking, and saying, "Oh yeah, I've invested in these companies and they've turned to billions." But you didn't run a company. You don't have no idea what it is managing. We're now 96 people, for example. You have no idea managing 20 people. You have no idea how the hustle to be able to build something from scratch with no brand name behind you. Even if you join a small investment bank, the idea is you're an investment bank and there'll be some sort of branding there which allows you to be able to step in a room. And so it's everything from the hustle requirement to push and persevere continuously, because you're getting punched in the face constantly, right?
Yeah.
That's one aspect. Second aspect is people management, and it's different realms. Again, when you come from the banking world, consulting, banking, whatever it may be, you're dealing with one segment of society when we're in that workplace. Everyone tends to have a similar education background. Everyone tends to have a similar demographic background. But you may have disagreements, but managing people over there is much easier comparatively to managing across the spectrum. And so, as the CEO, you are HR as well. Anyone who's going to be good at this, you have to be HR as well, because you're the managing people aspect of it's really. And then it's juggling many balls at the same time.
Yeah.
You're from one meeting to the other. First meeting could be about simple things like rent negotiation for the place you're in, and the next meeting could be you're raising your Series A and have to pitch the entire company, right? So the spectrum that is there is very vast comparatively to what you'd see in a typical white collar role, or at least in the banking world. So yeah, I mean, that's just scratching the surface, to be honest, in terms of the things which I am learning still, which definitely didn't have training for per se, having had a career in banking.
Totally. And it's so hard to assess also from an investor point of view, that grit initially, or that, hustle mentality. There's a lot of things that could be very interesting about a consulting, banking, whatever background, structured thinking. But some other things that are more intangibles are so hard to understand ex ante, just in a couple of conversations. But so moving on to the choice of why EWA and the earned wage access model, because we didn't cover it that much in detail, but you have a tremendous experience in fintech throughout your roles in the past, and you've covered payments, consumer fintech, lending, and so I'm assuming your choice of EWA was very deliberate and very calculated. So what led you to this particular model and not other things?
So cultural. The starting point for me was, you can come in and say, I want to do fintech, but what is it in fintech you want to do, and also what is it that would be adopted by the market you're going into. What I mean by that is, what is the pain point that exists in this country you're going to be providing your service in, and do people do that manually already? Because otherwise, if you bring something, I always semi-laugh, and hopefully it works over time, but people go in with budgeting tools or semi-savings tools, for example. These aren't problems people necessarily, they may have that problem, but it's not top of mind at the moment.
Yeah.
So adoption rate tends to be very low. And even to be honest, in developed markets, a budgeting tool doesn't really 100% work. And so what you want to do is make sure you're honing in on something that they do on a manual basis and you make it easier for them to do. And then you provide the credit on the back of that. And that goes into my always thesis as what I wanted to go into as a first model was a credit first solution. I'm always a believer and have always backed credit first companies because at the end of the day, in emerging markets, this is time and time again, people are credit starved. They're not payment starved. They are not budget starved. They are not a wallet starved. That's not what they don't wake up in the morning like, oh, I really wish I had a place to put my money. It's like, no, that's not what they care about. I wish there was an easier way for me to pay my utility. No, that's not what they care about. It's that I literally live from paycheck to paycheck. I do not have access to credit. I want to spend more, but I cannot because I don't have the means to be able to spend more because no one would trust me enough to be able to give me a form of credit. And by the way, specifically when it comes to EWA, my salary has kind of been the same forever. Despite I'm seeing inflation go through the roof continuously, the currency continuously moves down, and there's nothing really for me to do about that except to go to my family and friends and us for a spot, or you go to your employer. So it's very culturally normal in Pakistan and the region for people to go to their employers and say, hey, look, you delay my payments when it comes from a salary perspective already. I mean, pay cycles in this region tend to be between 35, 40 days, all the way to 90 days, right?
Wow.
It's bi-weekly in the US and most developed markets. So the idea is that you do this manually. I come in, and with us as Abhi, we come in and say, look, we will automate that for you. Why should you have to go to your boss? Why should you go to your family when this is money you've earned? So we'll give you access to that. So that's one part of the equation. The second is that for the business as well, it's very important because you don't have to deal in HR, CFO. They have to deal with this from a manual process as well right now. So depending on the time of the year, it goes up dramatically where you can have almost 60, 70% of your employee base coming and asking for salary advances on an ongoing basis. And so when you automate that aspect of it, it makes their life easier. So that's one aspect, making a manual process easier and giving you access to credit, which is a fundamental right and easy for us to be able to step in and provide. Now that's the easy part, by the way. The easy part is giving money. The fundamental reason why we did EWA as the launching pad, as opposed to, and going the route we did as B2B2C, is that giving money is easy, getting paid back is even harder. So it's the idea, so it's called speed loading. The idea that you can funnel as much cash into this as possible. And then when you finally trying to collect, that's where the NPLs kick in, and that's what causes companies to collapse, right?
Yeah.
And so that was the second most important part of this. It was this idea that if we are tied into the employer and we are tied into your payroll, my ability to get paid back and close the loop of disbursement, collection, that's the holy grail. Because once I have that, then I'm able to build a formidable business with risk control parameters, which is very important. Risk control is a key element of a lending fintech. So that's essentially the main reason why, and it was a big enough problem and easy enough in terms of a user base that we could bring on that's large enough to then use as our first product to be able to launch before going into anything else.
Yeah, that makes sense. And we'll delve into kind of the business mechanics of Abhi in a little bit. But before that, I just want to ask about two very laudable on the surface, but also oftentimes overused terms, which are, financial inclusion, number one, and the other one is concept of increasing digitization of emerging markets. And so curious to get your thoughts around what do you particularly mean or think of when you talk about digitizing emerging markets and financial inclusion, and how much of an impact do you really think fintechs have? Because it's very easy to say, right? Like, oh, we're driving financial inclusion or we're pushed digitization forward. Like, do you think it really has an impact, or maybe we're working towards it? Just want to talk and pick your brain around those two concepts.
Yeah. Overall, it can, but I think in entirety, depending on the model you're in, it can be a lot of BS as well. And the reason why I say that is, I'll give the example of some of the MSME payment players, for example. So that's a great model, but the issue is, one, the person who's running that small MSME store, so Kirgana store in Pakistan and elsewhere in the region, they're doing on a ledger, which is, well, a ledger when I say is a
You're talking
notebook,
about the
and
ones, the kind of the Kata books of this world.
yeah, exactly. So
Yeah.
similar to that model, monetization for me is important to build a business, and the part of that as well, which is important over here, is, are you really fixing something? So you come in, you provide a fancy app, or even if it's a WhatsApp service, and it makes it electronic. Now the problem is, what we've seen in that space is, the more players that come in, what you're actually doing is a customer CAC, right? Everyone talks about CAC, customer acquisition cost. What is your customer acquisition cost there? It's basically trying to convince a store owner that, stop using your notebook, use my app instead. I'll give you an incentive to use it. But then what's not worked over time is when you start going and say, hey, I'm actually going to start charging you for that digital ledger I've created for you. Automatically goes towards, whoa, whoa, whoa,
Well,
this,
yeah.
this is not what this is not what I want. You were giving this for free, or you were paying me to use it. That makes sense. But now you want to charge me for it? Actually, I'll go back to my notebook, right? So that's where I think the BS of digitalization of financial inclusion is, because cash is still frictionless. Cash is the king in all these markets. And so with us, for example, it's that all we're doing, and so Abhi means now in Urdu. And the idea is, we're getting you access to your cash now. And the way we do that is straight into your wallet, straight into your bank. We're not a wallet player. We're not a bank account player. We say, wherever you need your cash, we will get it then at a click of a button within 20 seconds. So that's one. So we don't care whether you pull it out as cash. If we can get you cash physically as well, we even tried that, worked with a couple of players that we could get, as long as the unit economics made sense, we would deliver the cash to you as well. What we did, instead of going down that route, is, don't reinvent the wheel. There are enough. Maybe they're not enough ATMs across the country, but there are a lot of ATMs across the country. In fact, a lot of the factories where our employee base is, or not our employee base, but our customers are, where the employee base resides, they have a lot of ATMs on premise, because the banks wanted to set up over there so that people can take out their cash immediately from the ATM, as opposed to walking miles and miles from their home to be able to get the ATM. So we said, okay, here's a prepaid debit card. It's linked directly to your EWA balance. Now, anytime you need cash, you just need your card. Use your card, boom, you're able to take out EWA balance. So the idea is, that's what's more important. Don't focus on trying to forcefully digitalize for the sake of digitalization. If they want cash, give them cash. Cash is fine. So I'd say that's where I believe in the financial inclusion part of it, but the means of it and the way you do it without wasting money, without wasting VC money on customer acquisition cost, is the most important part.
Yeah, no, I agree. And it sometimes, people get tripped up with this, and it's like, yeah, financial inclusion, why not? Obviously, I want, I can get behind that. But then when you start getting into the details, and if it's really helpful, to your point, sometimes it's just a means of acquisition that's really not that impactful, at least today, right? Maybe it's just a matter of building step by step. So going back to kind of dissecting Abhi's business model and business mechanics, we've looked, but this model has been around for a while, and I'm sure you've looked at models outside of Pakistan and outside of the countries that you're on today. Curious to get your thoughts on, did you grab stuff that worked in other models and maybe try to avoid some other things or mistakes that they might have done? We're investors in Minu in Mexico, in Nano in Vietnam. We've looked at Wavestream in Europe, at Earning in the US, so that this is a model that obviously with different intricacies for each of the regions, but curious to get your thoughts around, this model applied to where you are today, and if you grab different things from other players as well.
Yes and no. So when I launched, when Ali and I decided to launch this, that was step one for me. Step one was, given the connectivity through my career to the different companies that we had either invested in or looking at, etc., or through Dave Nangle at VEF as well, was, please connect me with everyone who does this across the world. And I spoke to maybe like 10 to 15 players over the span of whatever time period. And rigorously, and that's a typical, and this is what I mean by the the difference between investment banking and actual operator. So you go in, you're like, yeah, okay, yep, this is what they did there, this is what they did there, this is what they did there, this is what they did there. You
Put in
collate
a
it, and you're like,
slide and
okay,
then
yeah, you're like, this, okay, this structurally makes sense. This is what I should be doing. Yes, that's my go-to market. And the truth of the matter is, parts of it are true. Parts of it, yes, make sense, and there is some similarities between the markets and certain things you can fix on to be able to be more efficient. But the truth is, every market is different, and this is something even I remember when I was speaking to Portman at WageStream, who's an investor with us. He said, I've stopped giving advice to all the emerging market companies that we've invested in, because I've realized that it's the way they do it sometimes is better than us. And so there's no point in giving them a developed market solution to something which doesn't necessarily translate in an emerging market, and vice versa in emerging markets to other emerging markets. So it's a mix of the both. I still do a lot of connectivity between certain companies and founders who I truly respect and these more typical pain points, I'd say, of relationship management, customer relationship management, internal dynamics when it comes to again, like I mentioned, being a human resources manager, people manager as well, stuff around that. But around the business itself, I'd say it's few and far between where you'd say, yep, this worked there, therefore it has to work over here.
Yeah. And again, comparing models around the world, from my point of view, two kind of distinct routes that I've seen entrepreneurs take, and there's a lot in between, is one, you can double down on the employee side, effectively becoming, in essence, a neobank, if you want. And on the other side is doubling down on the employer side. And obviously you can do both in between, and you guys are doing both, but I'm curious to get your thoughts around that choice between kind of the neobank route and the SME provider on the other side.
Yeah, I'd say neobank as a term has played its course. It's been,
I agree.
one
Maybe
of those...
it's maybe I'm not using the right term, but
yeah.
you know
No,
what
no,
I mean. On the consumer side, yeah.
Exactly. And so the idea is, for us, consumer is still important. It is something we 100% have focus on. However, brand equity takes time to build, and trust is something that takes time to build. And so if you want to step into a market and build a formidable business over the long run, don't expect that uptick to happen on the consumer side, especially in a place maybe like Pakistan, even emerging markets in general. I was talking to someone earlier about this, because these are not developed markets where credit is inherently trusted. I'll give you an example. When we first launched, we went live with the company on a very simple, basic WhatsApp model. We just put posters around the office and said, if you want your salary in advance, WhatsApp this number, bank account details, we'll do the rest. For the first 2 weeks, we had like 1 or 2 transactions. What's going on? I mean, it's very clear what you have to do. We're tied in with your company. We had the company's branding behind us in terms of who we went live with first. Why is it not? So we ran a focus group. And when we ran the focus group, it was trust was the issue. They said, where's the...
But not trusted by the people supposed to get the credit?
Exactly. So they're like, so they said, look, we've seen this before. I mean, people give us money, and then there's hidden clauses, and then if we can't pay back, then suddenly these crazy interest rates come in, or they come to visit us, and thugs come to our house, like all this stuff. So we said, listen, it's not the case. We're literally tied in with your company. Your company has endorsed this. The moment that trust factor got built and word of mouth kicked in, which was way more important than any advertising you try and spend or put any fancy videos of trying to explain how the process works, then we saw the activation rate increase. So
interesting.
My point being that it's definitely an area we're focused on. However, at the same time, B2B inherently is also a massive issue in the country. So in the interim, if I can help solve B2B, especially in the SME space, it's a very lucrative business. It's a very deep business, and it allows me to run a very profitable enterprise while being able to be patient on the B2C side. Because otherwise, what ends up happening is you chase growth or you force growth in an irrational manner that causes your cost structure to be completely outweighed. And then when it doesn't kick in revenue wise, then you're continuously trying to raise to be able to plug the gap, and then dilution happens, and you build this crazy workforce, which then at one point someone's like, you know what, you tried, didn't work, and then you shut down the company, right? My idea is that you have to be patient with B2C, and this is
So
the way you be
this is interesting. So I thought what you were referring to was more, hey, we're using B2C as a wedge and maybe to get the employer side and then start offering more and more things on the employer side. But what you're saying right now is, yes, it might have been a wedge, but we're also kind of bullish long term. It's just a matter of timing. Is that correct?
Exactly. So the idea is that I'm seeing the numbers. I know inherently, this goes back then to basics and fundamentals, right? If you have 100 people who are your customer base for 2 years, for example, and you know those out of those 100 people, 65 to 70 of those people are using your app continuously, month on month. So your cohort retention is actually very high, which means people actually want this product.
Yeah.
Right? There's no advertising going. They've downloaded the app now. They're just in this loop. They like it. They want it. With that one product, keep on going, keep on going. That tells me inherently people like this product. Now, the only thing that is missing in this is the scale of it. Now, the scale of it, again, depending on each market, takes a little bit of time because you have to convince the business owner as well. The integration, we talk about integration and API integration, for example. That's a great thing to have when you're in a developed market. In developing markets and emerging markets in general, a lot of the companies, large companies as well, don't have sophisticated IT systems. Yeah. So when you want to do those integrations, it takes a little bit longer. And then again, when you start fresh with that company, the trust curve has to increase. So for us, is saying that this is a product people want, but I know I have to be patient with it, as opposed to the B2B side, where you're dealing with a level of sophistication where they just understand working capital requirements. Yes, I need that, and I don't have access to it. So it churns quicker. It allows you to build a profitable business at a quicker pace, and it subsidizes you to be able to keep this going until this really starts picking up.
Yeah, because it's very hard to monetize, right? Some companies in this model, they just give the withdrawals for free. Some other charge a whatever nominal amount, a couple of cents per withdrawal. So it's very hard to actually monetize this in the beginning, and unless you hit a certain scale. So just to double down on or double click on this unit economics or cost structure discussion that you were discussing before, one often overlooked piece of unit economics in these businesses, especially in emerging markets, is the access to debt. One thing that was important to me to understand is, okay, access to capital, what's the level of debt you can get or interest rate that you can get, but more importantly, what's your hedging strategy if you're getting that debt in US denominated debt as opposed to local currency. And I think that could throw your economics out the window, right? What are some of the challenges with debt and local currency and access to local currency debt?
So that, I think, is one of the pros of having come from the banking background. I have been on the wrong side of the trade when investing in a company that had currency mismatch in their balance sheet.
Yeah.
Because one thing for certain in emerging markets is volatility. The one thing for certain in emerging markets is uncertainty. And so you can build a great business model and access to capital at different various times of the cycle look very lucrative. But if anything goes wrong with the macro, and this is where macro is very important in these countries and understanding it comparatively, macro goes wrong, it goes wrong for a while, and it can completely kill your business. And so I made a point from the get-go that us as a team would never take international debt to finance our balance sheet on a localized basis if there is a significant delta in terms of the pricing for us to not be able to offset it if there was a change in currency. And in a steady state, you're looking at 6-7% depreciation, for example, in Pakistan on a yearly basis when it comes to the currency. And
Yeah.
typical in emerging markets is around that as well. It can be lower at 2%, it can be as high as 15%. But think about it, when we launched the business, it was 166 rupees to the dollar. It's now 220, it went up to 250 at one point, right? And so if you've borrowed in dollars at that point, your IRR would have to have been in excess of like 75-80% for you to even, one, think you're earning anything, and two,
Yeah.
there are enough dollars sitting in your local country that you're able to then expatriate that out so that you're able to then give that and pay that dividend back to your VD provider. So that's the element I'd say is difficult for emerging markets, is you should, in my opinion, do not take that cheap debt capital that you think is cheap, because it's not actually as cheap as
Yeah. So maybe let's talk about that. Like, what are some concrete advice that you can give to entrepreneurs in emerging markets that need access to capital and to debt capital in some capacity? What things can you encourage them to do? Or maybe some practical advice that you can think of?
Local. So one, you can go to high net worth individuals who are looking for yield. Private wealth managers in the country exist in emerging markets. They're typically looking at, so look, treasuries is the easiest thing people go to, but anyone who's high net worth individuals understand there's like real inflation in the country, so there'll be a inflation adjusted return that they would be looking at. So you'd be able to put together a syndicate of high net worth individuals to create a debt instrument for you to fund the balance sheet. That's one. Two,
do you do that on your own, or do you go to a bank or someone who syndicates it?
You can do both. So depending on your background, depending on who you know, you can either do it yourself, or you can go to a bank.
Because that's number two. So tip number one is go local. Tip number two, okay, what are my options? Because there's not a lot. Yeah.
Exactly. So one is that. Two is, once you've proven your balance sheet out from an equity perspective, that's where banks become a little bit more open. And especially now, I'd say the big delta that has happened in the last few years is banks are now understanding that fintech, especially lending fintechs, can be formidable.
And you mean local banks, right?
Local banks, local banks can be formidable businesses, and also that they cannot replicate this internally. They've tried and it just hasn't worked. So they're willing to work with fintechs to say, okay, here, we'll give you some funding for you to be able to go and build further. So that's the second one. The third one, which is what we're doing currently, is we're going and typically in some of these emerging markets, the debt market is actually deeper than the equity market, because equity culture is really not there, but debt is. You can do a private placement bond. And so that is to institutional investors, because they tend to be a deep pension fund market, mutual fund market, treasury market, that you'd able to go in and say, okay, I'm going to do an instrument, a bond instrument for you to be able to subscribe to. That requires rating the instrument, etc., and all that. So that's the third route you can go down.
That's great. That's very useful advice. Interesting. So continuing with this discussion around emerging markets and kind of how to operate, and maybe giving advice to entrepreneurs in emerging markets. This could be true for MENA, for Pakistan, for Latin America, for Asia, like true around emerging markets. One thing I'm seeing in a lot of fintech companies around the world is this what I call kind of crisis paradox, right? Which is interest rates are going up. Maybe some countries are heading towards a recession. Things are harder than they were last year. But at the same time, we're seeing kind of record demand for a lot of these lending or credit businesses, right? Because to your point before, people are cash deprived, and so when things get tougher, they need you more than ever. So maybe talk about that paradox, and how do you really capitalize on this opportunity without kind of blowing up on the process?
Yeah, I think that the last part of that was the most important, is process. So these are great market for lending fintechs, because what happens, especially in emerging markets, is your traditional banking sector will go back to what it originally does, is taking cheap deposits, chucks it into treasuries and makes the spread. It becomes one big, essentially, treasury function. It's risk-free return, high ROEs. They'll do that all day long. What happens then is you end up getting, and this is what we're seeing, larger companies who are still SMEs, but in the large space that wouldn't necessarily come to you for lending before. They are now coming to you because they're tapping out of their lines from some of the banks, and the banks are stepping back. So you're able to press the accelerator. So what you're able to do is, with your processes, get more control in terms of how you are assessing the risk on the entity. And this is where I think your risk department now needs a lot more beefing up and understanding of what exactly it takes to lend into the space. And once you get semi-comfortable with that, press the accelerator. Because market shares, I always say, market share, some people say, market share is won in downturns, not upturns. A monkey can win market share in up market. The idea is, can you, when the chips are down, this is when you build brand equity, because you are the source of lending and the person who's standing by a business owner and employee base when no one else was. So they will remember you on the other side of the cycle. And two, you have less competition around you as well to be able to do so. So that's where I'd say it's actually a really good time for lending fintechs to just
totally agree.
On
the flip side, if you get sloppy, you can blow up in the process as well. So completely agree. This is a tremendous opportunity, but needs to be, companies need to tread carefully, I think. Maybe this leads me to my next question, which is, without giving away any secret sauce, what things can you do? What steps can you follow to make your credit engine more robust? To your point, like, yes, okay, we're tackling, or we're expanding our business because of these opportunities that we have in front of us, but let's make sure we tweak the model in a way that we grow in a sustainable way. What things, or what high-level things can you do in order to make the credit engine more robust?
Collateralize. So in an environment where rates are low, people will look for non-collateralized financing because they can, because money's flowing, and your competition is allowing that to happen. The beauty about this market is you have capital. The client wants the capital to be able to sustain their business or possibly grow their business, but the power is now in your court. And so with a little bit of collateralization, it protects you from the downside as well. So step on the collateralization aspect and then be able to control your risk that way, so that should anything go wrong, because the issue is in this environment is even your risk metrics on an uncollateralized basis may look fantastic and the company may look fantastic, but black swan events happen during this downturn as well. And so the business owner themselves may not even realize what's going to go wrong. So how do you protect yourself in that? Is making sure that should anything go wrong, you still have some semi-form of recourse to be able to gain a part of your capital back. That's what it is. And so collateralization is literally the holy grail when you go down this route.
Got it. So it's not only tweaking on the lending side and on the model, but also kind of protecting your downside through collateralization and other initiatives.
Yeah.
Got it. That makes total sense. One thing that you mentioned a couple of minutes ago was the opportunity of you guys moving from kind of the SME segment, sometimes potentially, to more enterprise clients or clients that you wouldn't have serviced before. I want to talk about the SME opportunity, and maybe let's lay out the picture for our listeners. Like, how big do you think is the SME opportunity in Pakistan, in emerging markets? Because this is a pitch that we hear constantly in emerging markets around the world, is we're going after the SME segment. We're going after SME segment. So maybe step one, let's kind of paint the picture of why this is such an important and attractive segment to go after.
It's a real driving force of economies. So if you look at Pakistan, for example, I believe the stat is around 80 to 85% of GDP is actually SMEs. And so the two elements of this, right? One, there's SME composition of the economy that actually is the underlying belly that doesn't have access to credit and is building their businesses based on cash flow, which is inherently inefficient. And so therefore they should have access to working capital financing to grow the business further. Two, they're outside the formal economy as well. So there's this huge gray area, which is in the economy, who have no idea about interest rate cycles because it doesn't matter to them. This is why everyone, macroeconomists always get this wrong when it comes to emerging markets, right? They're always like, oh yeah, inflation's out of control, so we'll just increase price. We'll increase if the monetary policy goes into effect, they'll increase the rates, and then we'll be able to see growth come up. Never 100% works, because monetary policy is a blunt instrument in a country where financial inclusion and credit penetration is so low.
Yeah.
It works very well for those 10% of people or 10% of companies that are embedded on an interest rate. There's a parallel economy that exists in the country where they're borrowing at probably much higher rates, which is informal, has nothing to do with the local benchmark of KIBOR or
But
whatever
wouldn't it
is
mean in tandem, like even if it's higher, wouldn't it go down or up based on the benchmark interest rate, or not even?
It tends to be flat. Because they tend to be loan sharks, right? These are loan sharks who just say, look, this is my pricing, no matter what the economy does. I'm making 80% plus on my my credit term. So I mean, you have to be probably something like Argentina or something where inflation goes absolutely, or Venezuela where inflation goes absolutely berserk. But otherwise, in these semi-ish stable countries, the black market's always there. And so that's where I'd say you're where it doesn't 100% work in these markets. That's where SMEs still thrive throughout, because they're used to
it. Yeah, that's crazy.
They're used to it. They're like we live based on our cash flow. So whether the economy is growing at 6% or whether it's declining by 2%, we are always running based on the cash we're able to tangibly see. And so that is the untapped opportunity in this, where you're able to step in and say, hey, by the way, you're running a really great business, but guess what? I've looked at your working capital cycle now. The problem is that you have a fantastic business. It's just that you have a terrible working capital cycle. And so if I can come in, and this is where we now position ourselves, we're your embedded finance platform as an SME, because we come in and we say, okay, I've taken a look at your books. This is where the problem lies. Your ARs does not equal your AP. And therefore, you were running your business based on the cash you have. How about we help you grow your business by even 20% more a year by just giving you a semi-form of working capital financing for you to then do further purchasing. So stuff like that, things is such a virgin territory, an untapped territory at decent pricing in these markets, that you can still grow tremendously even when monetary cycles change.
Yeah, the opportunity in SME is clear, I think, but on the flip side, one of the things that we've seen with people targeting this segment is sometimes you experience, involuntary churn because businesses go out of business, or you have this constant push to try to, I'm starting with SMEs, but I'm moving up market. Do you think this is a way to rationalize, hey, I'm starting with SMEs, but ultimately I'm going to enterprise? Or do you think there could be a business that could be built only with SME segment and not going or not trying to go up market to a short tail?
Yeah, I think you can only focus on SMEs. I mean, I think places that have proven this are places like India. You look at the NBFC segment over there, like Chola, etc. They've only done SMEs, and they do very well. Even in Brazil, that exists. You look at Bank Jago in Indonesia as well. SMEs throughout. The issue is, look, what you don't have in emerging markets, and this exists in the US, right, or developed markets, you don't have a form of securitization for your asset book, your loan book, for that to move up, right? So if you look at the US, for example, there'll be an SME lender. That SME lender, or even lower than SME lender, you prove your book and they say, okay, now you've done your cycle so many times, you've actually increased your credit worthiness, that no longer do you actually need to come to me as your lender, because you've proven yourself to have a whole lower rate of interest through your cycle. So I'm actually going to sell that book onto a larger bank, which has a lower cost of capital. So their cost of funds are lower, and they're able to charge you less, right? So I say, okay, here's my book. Thank you very much. You've been a great client. And by the way, it allows you as well to be able to monetize that book as well as an SME lender. You just don't have that in emerging market. You don't have the stack that's built up in financial services. So literally you have just lenders to the large companies, and that's about it. So what the idea is over time, and I don't think this happens tomorrow, specifically in places like Pakistan, for example, is my idea is that we will have this book that churns, which then we can put credit scoring behind, et cetera, as well, which then eventually we can then go to the big, look at this portfolio of clients we have that we've had for the past 6 years, 7 years, and our default rate is, say, 2%, for example. here you go. Why don't you take it? They will benefit from lower financing costs comparatively to what we're charging them. And we can then reuse our capital to go back to the existing base and be able to lend to the SMEs that are now coming up that curve, right? So that's how you then start building up that financial inclusion of SMEs over a period of time. But it takes time for this to happen.
Yeah. Omar, what's next for Abhi in terms of product roadmap? Because and I want to tie this discussion to what we discussed previously on the going to the consumer side, to the business side, because you've been launching a couple of features and products to both sides. And so maybe just number one, just name a couple of these and just tell us the latest about what's going on at Abhi. And then let's pair that with an advice for entrepreneurs on how to balance, hey, these all new initiatives with kind of focus and kind of keeping the efforts around a certain couple of things and not try and kind of shoot everywhere and do too many things at the same time.
Yeah. So new initiatives we're working on. For us, it's just going deeper in the relationship. So understanding both the business owner as well as the user on the EWA side of what they're using the capital for and providing them a way to just stay within your ecosystem. What do I mean by that? So on the EWA side, we'll go and say, okay, you're taking EWA out, what are you using it for? And then say, okay, if you're using it for electricity bills, if you're using it for education fees, if you're using it for medical bills, how about we just embed that within the app so you don't actually take out the cash? It's not, it can automatically send that through. So that's one aspect. The second one, which actually ended up taking off pretty well, which didn't cost us anything, was we started noticing that when we went to some of the factories and stuff, people who didn't need the EWA, they were taking it out because their friends wanted it within the company instead. And they'd go, they take out the cash and give it to them, right? So we said, okay,
that's a Venmo, kind of Venmo-like.
Exactly. Exactly. So we created Venmo Pakistan, which is called Abhi Dost. So Abhi Dost means friend in Urdu.
That's great.
And the idea is anyone within the Abhi network and outside the Abhi network as well, is so you can send the money to them. So, I mean, I do it personally. For example, my family's house help, driver, etc., and all that for my mom and my wife and all that. We do it all through Abhi Dost. So we've automated our household without having to take out cash every time. So things like that are ways that we do. So that I'd say that's how we look at products that we add on, one that don't cost a lot, but also we know they're doing this already, and how do we just make it more tangible within our ecosystem. So that's one on that side. And so that's what we do on both ends. We've come out that we're launching next week the earned wage access card. So that's basically a pre-filled debit card, which is linked to your EWA balance. You go to boom, take it out, no problem. That's the other thing on the EWA side. The business side, we have gone into other forms of working capital financing. Before it was very much to saying, okay, this is your invoice. We want to discount that to today so you get access to financing. But now we're saying, okay, we're looking at your business cycle. Now we can give you some form of growth capital as well to help you grow the business. So that's I'd say the other side of that. And we can go deeper in terms of stuff like that. But I think the more important point is your second question is how do you make sure you aren't constantly spreading yourself too thin and having focus? The truth of the matter is it's less to do about spreading yourself too thin as long as you make sure everything is tied in to that existing framework you have. It's more about coming up with the idea, test it in a very low cost manner. What I mean is literally like a dirty MVP of manual processes before you go and build out the product, because that's where you get caught in that vicious cycle of hiring a team, building it out, and then it doesn't work. Then you have all these costs and it doesn't make any sense. So test it out very manually. If you see that take up happening, try and automate it and then see how it takes off. But then this part is the most important part. Kill it very early if you realize this is not working.
Yeah, that's great advice.
And so I think that's where people get it wrong. They just fall in love with this idea, like, oh my God, but it's going to be this. And it's like, no. But are they actually using it? Do they actually like the product? Do they want it? And you as the product owner or the person who came up with the idea have to be completely separate from this. Your user research people should do this. They should go out and they should come back to you and say, listen, your idea was stupid. It didn't work. Sorry.
Do you
And
put
that's where you
a
say you got it.
kind of someone responsible for these mini projects inside the company, like
Yeah.
a project owner, mini CEOs of these companies
Yeah. So
within
basically,
Abby?
yeah. So, I mean, I basically tell everyone, I say, everyone is incentivized here to be able to come up with an idea and we can test it. If it works, happy days. And we have an incentive structure to make sure that everyone is innovating constantly. So it doesn't have to be someone just with the product team. It could be someone in marketing, it could be someone in activation, it could be someone in operations, right? So think that's one thing I make sure that we focus on as a culture is constantly innovating internally, and everyone has that capability to do so. You don't want to keep it to just one level of department because then that can get lazy as well. You want to make sure it's coming from all directions because people have different vantage points from
Yeah.
every aspect of the business depending on where they are. So that's kind of how we've done it so far.
Got it. Omar, let's switch gears here. I want to talk a little bit about macro and kind of emerging markets, fintech writ large. So maybe just forget that you're an entrepreneur, where your investor hat, or maybe even better, we're both. And let's talk a little bit about this and kind of how can it impact you and others potentially starting businesses or running businesses and startups in emerging markets. Want to start with the US, and maybe that'll inform the rest of the discussion. What's your view on inflation? Do you think, there's broadly three schools of thought, one saying, hey, inflation has peaked, others saying, hey, we might be in a longer secular trend, and others even say we're heading towards deflation. Like, where do you stand in this debate and in general? And then we can talk about emerging markets.
Oof, it's a tough one. I'd say I always revert back to a famous quote, which don't know who originally said it, but it says, "A wise man knows a difference between those things that are in your hands and those that are not." And so you play the cards that you're dealt, essentially. And so, do I have a view on where inflation could be? Possibly. Can I base my business around that, of understanding how to run the business accordingly? Um, uh, Not enough to say I would take in one direction or the other just based on that view, because I think this is something that's significantly out of our control, and there are too many external factors for us to understand where exactly it goes. So inflation is there. Is it sticky? Possibly. Are we building the business with, and from the get-go, I think this is where it's very important, is the lending fintech, to make sure you have a positive unit economics model and enough of a buffer that you are able to absorb these price dynamics when it kicks in, because you will not be able to know whether and when it's going to happen. And so that's how we're looking at it from a strategy perspective. So my personal view is that we have possibly peaked, but we're probably going to stay sideways for a while. But there can be extra shocks, especially when it comes to EM, where you completely decouple, right? I mean, I'll give you an example. In Pakistan, you've got reserve situation, which is pretty low. The currency could be artificially held. And so even when interest rates start coming off in the US, if inflation has peaked, for example, in the US, and we go back down to, say, 1-2% interest rates in the US, Pakistan could move to 300 to the dollar, and inflation
Yeah, and
domestically
it had
goes
a
up to
pretty
40%.
rough year, right? Pakistan, in terms of
Exactly.
depreciation. Yeah.
Yeah.
Yeah,
So,
that was the reason of my question was, okay, yeah, if inflation has not peaked, or maybe the Fed is not going to pivot yet, that could have an impact on the US dollar, that could have an impact on emerging markets debt, et cetera, et cetera. And that's when it impacts you guys directly. But going back to our discussion around being smart around debt, that's how you maybe solve for it. Or that's,
exactly.
And to your point, I think it's very hard to operate a business depending on what will Powell do in the US, being in Pakistan or Brazil, or whatever. So totally agree with that. But I think, the key thing here is being unit economics focused, most importantly for credit businesses on the lending side, and be smart around, access to local debt. I think it's the key here that you mentioned before.
Yeah, for sure. And the point is that it's like the airline industry, right? The one thing so it's like one of the worst industries out there because you have so many variable costs which are out of your control that you could to run the business on an ongoing basis is almost like a flip coin of whether you're on the right side of the cycle or the wrong side of the cycle. With lending, and especially in emerging market lending, try and get as many things in your control as possible. And so the way you do that is by, again, currency mismatches not happening in your balance sheet. So have local currency matching when it comes to your debt so that even if cycles do move, you're not thrown off by what happens externally versus domestic. You do not have the privilege of running a company in a developed market style working in an emerging market. So those things on the macro side, which you can control and keep in your hands, make sure you do that. Because when things go out the window, you won't expect it to happen, and it can completely kill your business overnight.
When looking at macro as an investor today and looking at fintech, maybe even, the discussion, especially in early stage startups and fast growing early stage startups, is around multiples, right? And okay, what will the exit multiple be at the time of IPO or acquisition, whatever? And obviously, fintech multiples are being slaughtered in the public markets. And I think personally, I never think the idea of multiple expansion, of projecting multiple expansion, is a good idea. But some people argue that, hey, you know, you're in VC, you're investing with us, whatever, 5-10 year horizon. So multiples could revert back and maybe normalize, or like, do you think that's where we're heading to? Do you think we're going to see a normalization of multiples, or there's no such thing as normalization, and what we've seen over the past 5 years was kind of a blip in an overall trend, and this is sort of what we should expect going forward?
So it all depends on where you are in your age of the company, right? What's very interesting is I don't know if you saw recently YC, they did a video of their recent cohort that graduated out and where they saw the valuations being done at. To their surprise, there was no change. So on average, it was still between the $25 to $30 million mark, right? And the point being that at that stage, it's very different. You're not looking at multiples. You're saying, how big is this company? How big is the target segment they're going after? And how big could this company be when I'm putting in X amount of capital at that early stage for it to become larger? Where it does matter in terms of valuation multiples is, and this always happens when markets completely obliterate, that's when everyone's like, oh my God, but the public company is trading at this. Like, yeah, but that was never the comp to begin with when you were raising for that capital. I mean, when I was raising, for example, for our Series A, it wasn't what are public companies trading at for us to value this round, because it doesn't make sense. That's comparing apples to oranges. So I think the later stage you are, yes, there will be there already has been compression. I'd say that's where I'd say we're going to have the flip now. We'll probably start seeing some expansion happening. Does it go back to what it was at the peak of the cycle? No, in my opinion. I think it got stupid with a lot of companies. But if you are a decent business, when you're at that stage, you should be generating decent ROEs, and you're growing at 25 to 30% a year. There's no reason why you shouldn't be trading at 18 to 25 times, for example. That's okay. That's normal. But 50 times, no, that's not going to happen again, in my opinion.
Got it. Omar, thank you so much for the time. I want to give you just a couple of minutes for any closing remarks, or where can people find more about you, about Abhi, and then we can wrap it up with that.
Well, I'm terrible on social media, so I mean, you can send me see some stuff on LinkedIn, but that's mostly the marketing team that does a lot on does a great job on the Abhi page. Otherwise, Abhi, yeah, you can find out a lot. There's LinkedIn, there's TikTok. We have our own website. I have various strong investors like yourselves who supported us as well. Have written some nice things about us as well. So there's that. But about me, yeah, I'm very bad with social media, so there's very little.
Thank you for hopping on this. This was fun. Lots of things to talk about. I still have like 10 more questions that I want to ask, but really appreciate it.
No worries. Thanks for taking the time.
Yeah, for sure.